G'day, guys. Welcome back. Today, we're jumping straight into what's top of mind for pretty much every investor and developer in Australia right now, the RBA's rate hike recently, lifting the cash rate another 25 basis points to 3.85%. Now, headlines and economists can tell us, what's going on. There's plenty of opinions out there, but we really want to know is what's happening at the coalface for borrowing power, for deal feasibility, holding costs, refinancing, and how we actually position ourselves moving forward. So super pumped to have Matt Punter here from TSC Mortgage Brokers with us today. Matt's a broker who is working right in the trenches with investors and developers at the moment. He's helped a heap of people in our community over the years, structuring smarter finance, navigating bank policy changes, and keeping people's deals moving forward in even tougher lending conditions. So today, we're going to unpack what this rate move changes and what Matt is seeing in the market right now and what we really should be doing as investors and developers to stay ahead. So welcome, Matt. Thanks for sharing your time with us today.
Oh, great to be here, Matt. Happy New Year to everyone. Hope
Yeah,
everyone had a
awesome.
lovely break.
Good to get back into it, mate. Nothing like a bit of a rate rise to kick things off.
Yeah, it's going to be an interesting year ahead. I've been, as mentioned to you, I keep abreast of everything in the news. It's the mainstream news, so the Financial Review, the Australian Courier Mail in Queensland. I also look at the broker-centric media outlets. So we've got a number of different bodies, I guess, that produce material, and they do a lot of interviewing of different economists and things. So I've just been trying to keep abreast of where that's all at to try and anticipate where lenders might be this year and just where the opportunities are, because no matter whether
Yeah.
the interest rate market's rising or falling, there's always opportunity in there in one way, shape, or form.
Yeah, I think that's the case. It's everyone sees it as a negative, or depending on what side of the fence you're on. But yeah, it just changes the conditions, and there's always an opportunity around that. What's the practical impact for you guys as brokers? With not just the rate rise, but with the inflation above target, is there trends happening already, or pressure around what you're having to do? What's it look like at your end?
So definitely rates. We saw fixed rates start to move in probably November last year. So that always gives us it's a leading indicator of where rates are likely to go. The lenders,
Mm,
the majors really drive that part of the market, and then the sub market that sits under the four majors rolls in with what they're doing to try and remain competitive, but they don't want to be left out. So we find there's a general momentum that goes in a certain direction. We've already seen fixed rates go up. Whenever there's a rate rise, the interest rates, the variable rates move almost straight away, unlike a drop where they leave them for a little period. So
mm,
that'll affect borrowing capacity. So the biggest change that we'll see in our part of the market is that borrowing capacity will be diminished. It's a good thing and a bad thing. The bad thing is if you go to a major, they're very rigid. They've got a very hard boundary on the box of what they can and can't do. We
mm.
tend to deal with a lot of the non-bank lenders. The non-bank lenders, their point of difference or their niche in the market is that they can engineer policy to make sure that they grow their market share or maintain their market share. So I think what we're going to see in the next period, and certainly brokers that deal with non-bank lenders, which is it's increasing, but it's still very much in the minority. Most brokers deal with majors because it's easy, because the box is so rigid. You know exactly what you can get done, so it's quick. We
Yep.
prefer not to deal with the majors in a. We don't look at them first. We look at them for their policy. So some majors have got great policy around bigger properties, complicated properties, but and they might stand out as a preferred choice for those types of, it's horses for courses basically.
Mm,
In the
mm.
main, we're dealing with people that are looking to make money from property. So we have to look at what's the goal? Is it to acquire a site? Is it to release equity? Is it to debt consolidate to improve your borrowing capacity? So we take a bit of a different approach based on who the client is, but we definitely start with non-bank lenders, and I think that's where the opportunity is this year. Is if they can get comfortable with moving away from a known brand, there's a
Mm.
lot of lenders in the marketplace that really want to lend. They need to lend. And just the mechanics of that is that the non-bank lenders, they borrow wholesale funds from the majors in the main. So they basically buy their money to on lend to someone else from ANZ, NAB, Westpac, etc. There's three of the majors that do wholesale lending to the non-bank lenders. So
Yep.
there's opportunity,
Yep.
Matt. Yeah, I guess that's the message there.
Yeah, and I guess it's just being open to dealing with those non-bank lenders because they're not brand names. People may not have heard them before, but you guys are obviously dealing with them every day. So it's normal, I guess, these days to be doing that and looking for the best deal. And when you have this shift in policy, yeah, it opens up that opportunity. So yeah, it can be seen as a positive. Um,
Yeah, I really think
with
so. Particularly for people looking to be active. If it's a set and forget, then that might be different. But if you're looking to be active in property, and then
Yep.
to not look at non-bank lenders is probably you're missing out a little.
Yeah, yeah. So when they announced it yesterday, they kind of hinted, that well, they're not ruling out more rate hikes. From a risk management point of view, inflation could be sticking around above target for a while. How should we be thinking about that or planning for this kind of new cycle in the property market? Do you think just more from a developer or investor point of view?
Yeah, look, I think what's going to be key, given that there is the potential for more than one rate rise, is that
Yep.
if you can access equity, so everyone's generally got equity, we find property prices have done really well right across the country. So whether you're in a smaller market like the Northern Territory, they've had massive gains up there. South Australia, Western Australia, Queensland, has been phenomenal as well. So I think if you've got equity, now's the time to have a look at it. Go and see your broker, come and talk to us. Find someone who deals with non-bank lenders. So
Mm.
in the broking world, as in any world, there's different methods of getting things done. We really focus on borrowing capacity. We focus on unlocking equity for people. So find
Mm.
someone who does that, whether it's us or whether it's someone else, doesn't really matter, but find someone who deals with non-bank lenders, are comfortable, understand their policies, understand their methods of operating. So with a lot of self-employed people, for example, low doc lending is really, really popular, and it can
Yep.
unlock a lot of equity so that they've got the money now ready to go, because they may not, with another rate rise or two, they may not be able to borrow and get it out, or as much. So I think,
Mm.
like anything, it's preparation. Those that prepare early will probably win a lot more and be able to get into deals, whether they're,
Yep.
investing in other people's deals as a joint venture or a money partner. I think that's where the opportunity is going to be in the next 12 to 24 months, is people
Mm.
coming together to collaborate. I'm a big fan of it. As you know, I've done a lot of joint ventures with people, and
Yep.
I think there's a way there that we can come together to get more deals done, create more housing, because we certainly need it.
Yeah, yeah, no, spot on, mate. I'm a big advocate of that, of course, as well. And whenever there's a change in the environment, I'm always quick to just reassess. And yeah, where is the lazy equity there? What else can I access based on the market changing or lending environment changing? So yeah, it's good advice to really reset, particularly if we are in an upward trend with rates. It's not going to get easier. So yeah, you're right. Go and get revaluations done. Look at your capacity right now, and then see where it takes you. So the non-lending environment, non-bank lending environment, there it sounds like it's a flexible space. So it depends on what job you've got or business you run. You can sort of cater that approach with the right non-bank lender based on the parameters of the person going for that refinance or borrowing.
Yeah, very much so. Yeah,
Yeah.
it's we're I would say probably half of our book is we're an 11-year-old business, so we're quite mature. We've got 18 staff now. We do a lot of lending,
Mm.
and that exposure gives us access to know exactly what lenders are talking about. It also gets us a seat at the
Mm.
table, with the at the top end of town, to understand what is their credit appetite. So what they're telling us is, look, you present us something that fits within the realm of what we do. And if we like the client, i.e. things that they look at are, they want to look at your credit report. So who are you? What's your credit score? What facilities do you have? And just your reputation. They're banking clients, they call it banking clients. So they want to write loans for people that are reliable, have a track record, and have equity. So if you fall into that space, you're self-employed, there are ways that you can manage how you do it through your BAS, through your accountant, using your accountant who understands your business. So there's lots of they give us a fair bit of flexibility. What it tells me in the end is that the ones that are shifting their policy to make it broader, which is what's going to happen in this next period, they're the ones that are hungry. They want to write business, so they'll
Mm,
look for reasons to say yes rather than going, no, you don't fit within the box, and
mm,
therefore it's a no at a very junior level or even at a digital level. So a lot of the
yep.
majors they credit score and their approval is based on an algorithm. So you don't get to put a pitch forward and say, well, this is Larry and Judy, and they're really good people, and here's their credit score, and here's their history, and here's their equity. You don't get to
Mm,
do that with some of those guys. So we
mm,
think, look, our approval percentage is really, really high because we understand who the lender is, what their appetite is. We actually pick up the phone, have a chat to them, say, hey, got
mm,
a deal, looks like this. This is what they're looking to do. Here's our
mm.
evidence. We think it's a deal because of this, this, and this. Can you get credit to have a quick look at it with our synopsis? So we give a little summary. It's just about, I think the skill in broking is to understand who's lending in the market and
Yep.
how to approach them with to get a preliminary or an indicative yes before you put all the documentation together. So it's a
Yep.
bit of research
Yep.
and a bit of work in it. But again, the more preparation that people do to get ready, like there are opportunities there. You've just got to, get yourself set.
Yeah. And I've heard you talk about, just being able to do one more deal, or maybe it's releasing a bit more equity or something rather than focusing on the interest rate, for example. Because I know with a non-bank lender, they're more flexible and it's kind of more convenient. But what comes with that is the higher rate, or maybe it's a different LVR. Is that
Can be.
right? And how should
Yeah.
people be framing that to look at the bigger picture of what they're getting out of that creating that new facility?
Yeah, so the low doc space now, like when I first started doing low doc lending, the rate differential was about 3 to 4%. Now it's in the realm of 0.75 to 1.75, depending on what the LVR and what the risk is. So
Yep.
they've come because they're writing a lot more business, and the mainstream lenders, the guys that are lending the wholesale funds, they're reliant on this other layer. They make a
Mm,
lot of money out of these guys still.
mm,
So they're making money on the deals that they write, but they're also making on the deals that all the non-bank lenders, of which there are, I don't know, we've got 60 lenders on our panel, and we're with a fairly progressive aggregator.
yep.
So I think the opportunity that's there, that they want to get the money out. They're really keen to say yes. So
Yep.
you're paying a little bit extra, but if you're putting the money into something that's what you and I know to be a deal, whether it be a money lender to fixed rate or a joint venture with you know a, a reasonable figure at the end of it, then it's a no-brainer to spend an extra
Mm,
percent or percent and a half on the rate on the funds that you borrow is a no-brainer
mm,
for the opportunity. So it's all about the opportunity. And
mm,
obviously we want to invest into things that start with a big fat margin. You don't want to
mm,
invest in something too skinny. So it's just, again, having the right mentors. So you need to get access to the funds first from our perspective. Then you need to partner up with the right people, which means you need to be trained. So go and talk to the right people. Your inner circle mentoring is a great place for people to learn, network, and learning not just from you, but from other parties that are doing deals and have done deals. And what are the
mm.
things that you need to be aware of, or cautious of, and where are the opportunities? So
Yeah.
I think it's a layered approach for people that are looking to create a business or just a side hustle. It's a word I'm hearing a lot these days from people.
Mm,
I need a side hustle because living expenses are so bloody high, which is why
mm.
inflation is up here and why interest rates are going up. So it's a bit of a
Yeah.
cycle, I think.
Yeah, yeah, yeah. It's fascinating. I love getting little updates. I know you send every now and then of what lenders are thinking or what they're targeting. Because you don't hear that in the mainstream. So getting a little bit of okay, they're focused on this location or this type of strategy or these parameters can be really insightful and moves you away from the big bank mentality where, like you say, you're just ticking a box and it's an algorithm. Whereas in this form, you've got a bit more. It's more malleable in your approach, which is why we use you guys and brokers to be able to find that niche in there. Um, so I know we only got a little bit of time left, but are you thinking this is the norm for this year? This lending environment, inflation up a little bit. Do you think that's going to continue just in your what you're reading and your opinion around it?
Yeah, I think so. It's look, there's a lot of government spending. Everything that I'm reading to try and understand why are we getting these rate hikes when the trajectory was going down and now we're back up. And what it all boils back to, and everything that I'm consuming at the moment is government spending. So
Yeah.
state governments and federal governments, they're just spending so much, and it's driving up the cost for the private sector. So for you and I that are looking to do a project, we're having to pay a builder who's got the opportunity cost and his staff, his chippies and leckies and plumbers and all the crew.
Mm,
Their opportunity cost is go and get a government job, work on a government job where, they work less and get paid a lot more, or work on
mm,
private stuff. So we're all
mm.
scrambling for the same resources, and we're evidently paying a hell of a lot more to get everyone. So the cost of every project is, I've yet to see one come in on budget, to be honest. So in
Yep.
recent times, and it's still
Yep.
going north. So that's the difficulty we've got. So I think that, to answer your question the long way, is yeah, we have to expect that this may not be the end of the rate rising cycle. There might be one or two more. I think they'll be
Yep.
cautious. I don't think they want to raise rates because it does hurt people.
Mm,
But they do need to rein in the spending. I think there's a lot of media that's going to push into the government spending, and there's going to be a lot of
mm,
talk through the media about it, which will put pressure on the current government, state and federal,
mm.
to moderate. Because it's
Yeah.
they're driving the costs for private enterprise up.
Yeah. Yeah. No, spot on. No, it'll be fascinating to see how it goes. But yeah, like we said in the beginning, we can't control any of this stuff. We just got to work within the parameters and find the opportunity there, which there always is in this scenario. Anything else you just want to add, Matt, for the listeners
Yeah, look,
on
as a
this
property,
topic?
I just read a note before about, there's always opportunity. And I think the opportunity at the moment and for the next year or two is that it's going to be harder for people to get access to money that aren't lateral. So people that
Mm,
take the traditional approach, which is, as an ex-bank manager, people would come to me when I worked for Bank of Queensland and they'd say, "Can I borrow this money, Matt?" And I would say, "No, you can't afford it based on our credit criteria." I think what people have to make the movement. It's definitely a movement. It's happening. Brokers are writing circa 70%, above 70% of residential loans in Australia. So there's definitely a movement. I think to find brokers that understand the non-bank market is really critical. And once you do that, you're embracing low doc lending, you're embracing private lending, you're embracing joint venturing, money partnering. There's huge opportunity because it's going to be harder for people that don't look outside the square.
yeah.
And property prices, I think, it's still they're projected to rise because we just don't have enough product being built. There's not enough supply.
Yeah. Yeah. No, that's spot on, mate. I think, yeah, that's the key creativity, getting around others that are doing it. Yeah, I've always been a big fan of collaboration if you can find the right people to do it with. And we certainly help facilitate that with our networking group and the members within that, the inner circle group. There's a lot of people doing some awesome stuff, some great deals. So for those that are struggling to get into those deals or do their own or find the funding, yeah, you've really got to tap into these sources and find a creative way forward because you don't want to lose deals based on funding because there's always a way forward with it. There's always a way to get it done, and I know you
Yeah,
guys really support that as well. So yeah, that's awesome.
yeah, we love helping people to people are trying to move forward. They're investing time, they're investing money. So we're here
Yeah,
to fully support them, and we love that. That's the part of the market that we play in is helping
yeah,
small business people and people that are having a crack trying to create something for their families.
yeah, awesome, mate. No, always great to have you here. Massive thanks for jumping on and breaking this down in a way that actually matters for people like us that are investors, developers, not just the economists or the opinions in the news. It's really good to hear your thoughts, Matt. And yeah, those watching or listening, if you want help reviewing your loans or improving your structure, unlocking borrowing power, or just getting clarity on, what this new environment means for your next move, yeah, definitely reach out to Matt and his team at TSC Mortgage Brokers. They're right across this stuff and genuinely get what we're doing because you guys do it too. I know you're in plenty of deals as well, Matt. So you got both sides of the coin happening there. So yeah, thanks for watching, guys. If you want more of these sort of market updates, rate moves, and on the ground type insights as things change, Make sure you're part of our community, whether it's in Ultimate Property Hub or in the Inner Circle, or just coming along to our networking group meetings. Matt, you're actually speaking there this month at the Broncos Leagues Club for our Brisbane Property Networking Group meeting, so we'll be able to touch on all this again. But yeah, this will really help a lot of people, I think, in bringing them into the conversations and the information that we've got at hand, so everyone's making good choices going forward. So thanks for your time today, Matt. Look forward to catching you at the meetup later this month.
Wonderful. Great to chat. Thanks, Matt.
Cheers, mate.